Welcome to our Series 6 discussion on common stock. During our conversation, our learning objectives are to first define what a common stock is, second, look at common stock features, third, talk about the corporate charter, and finally discuss common stock voting rights. A common share of stock, or common stock, is the first security that a corporation will issue. Once a corporation has issued common stock, then it can issue preferred stock and bonds. So there's no such thing as a corporation that has not issued common stock. It's just the baseline ownership of a corporation, and we have equity when we're a common shareholder. So when we talk about features, you hear me say this for a common share all the time. So it's share or stock, and the ownership is also referred to as your equity. You're an equity owner in the corporation because you own a piece of that company when you buy a common share. The par value for common stock is an arbitrary number to set up the books. We don't really need to know the number to set up the book. Common's a buck. Instead, we need to concentrate on the market value, the price that the stock is trading at a current time. So some different feature of common stock is that they have the right to vote for the board of directors. They have the right to inspect the books and records of the company. They can transfer their ownership to another investor. We call this trading in the market. They can maintain their proportionate ownership and interest in the company when the company goes and issues new shares. These are called rights, preemptive rights, and they have the right to receive a dividend if declared by the board of directors. And unfortunately, common stock is the bottom of the totem pole. So if the board of directors does declare a dividend, the common stockholder will receive a dividend last. So now let's look at the corporate charter. We sometimes hear this referred to as articles of incorporation. So we'll look at the corporate charter, and this is also referred to as the articles of incorporation. This is the document that gets filed in the domicile or state in which the corporation is located, the state in which the company originally incorporates. So this is the capital structure that includes something called authorized stock. So with authorized stock, this is just the number of shares a corporation can issue over the lifetime of the corporate charter. And usually with authorized stock, it's a very inflated number because they don't want to have to go back in and change the number of authorized shares in the corporate charter because then it requires shareholder approval. We have to hire lawyers. It's very expensive. So that's your authorized stock, the total number of shares the company is authorized to issue. It's an inflated number because we don't have to go in and redo the corporate charter just to increase the number of authorized shares we want to offer in the market. Issued stock, this is the number of shares sold in the market. And then outstanding stock, this is the number of shares actively trading. And then we've got something called treasury stock. Treasury stock is stock that the issuing company this is shares that the issuer purchased itself in the secondary market. Treasury stock plus outstanding stock equals issued stock. Treasury stock plus outstanding equals issued. And then we have something called treasury stock. Treasury stock is stock that the issuer, this is stock that the issuer purchased itself in the secondary market. Treasury stock plus outstanding stock equals issued stock. Make sure you know that. And while shares are held in this treasury, they have no voting rights and no dividend. They're basically shelving these stocks for maybe a large equity acquisition expense or something. They can use these treasury shares possibly in the future for some major expense, possibly an acquisition. They need money for funding to take over another company. They could use some of these shares that they have in treasury, sell them, and use them as equity to fund the capital for the acquisition. That's why maybe a company might purchase some of its own shares, shelf them, keep them in the treasury, and use them for maybe a business expense coming up. They'd like to acquire Netflix, and they need to raise $300 billion. Hopefully their stocks performed very well, and they have enough in its treasury to make the acquisition price, or they may have to go to investors to raise capital through bonds. So treasury stock plus outstanding stock equals issued stock. And remember, while they're held in the treasury, they have no voting right and no dividends. So common shareholders have the right to vote. What are the items that they have the right to vote on? Declaring a stock split, declaring a reverse stock split. If they want to issue a convertible bond or convertible preferred stock, they have to approve that as a stockholder, right? A majority vote. Or issued stock options to officers on a preferential basis. Items not Declaring a shareholder vote is declaring a cash dividend, declaring a stock dividend, declaring a rights distribution, or repurchasing shares for its treasury. So that's it, you guys. We've talked about common stock, defined it, looked at what common stock features has, and looked into the corporate charter to look at issued stock, outstanding stock, and treasury stock. Finally, we've talked about the voting rights for common shareholders. That concludes our session on common stock. You're doing very well moving along with our Series 6 exam video prep series. I'll see you in the next video.